Hey guys, this is Mr. Roxy. I am broadcasting live from Palm Beach in Florida. It is approximately 5 p.m. on Tuesday. It is May the 11th, and today we are playing Survivor, the Wall Street version. So I'm sure by now, if you've been following my channel, you will know that today was another one Maserati, two Maserati, three Maserati day. Who knows, right? You see Oxy down at what was it, like $24.60 or something like that at the end of the day. I'm not sure if I actually had any stocks that were green today, but yeah, you know what? Tomorrow's another day, so we'll see how we go. What I wanted to do today is take a few minutes to sort of give you the highlights reel of the earnings call that was held earlier today. It was 1 p.m. Eastern time. I listened to it, and then I downloaded the transcript, and I thought, you know what, I'll just save you guys the time and the effort to go through this. So I listened to the conference call. I took some notes, and then I downloaded the actual transcript, and thought I'll just go through it with you guys quickly. So from Oxy, you got the usual three musketeers on the call. Jeff, who's the VP of Investor Relations. You got Vicky, who's the head of honcho, and you got Rob Peterson, who's the bean counter. You've got a few conference call participants. These are some of the analysts that I follow, and by now you will know that I dearly appreciate and love them very, very much. So let's go into the actual transcript. And what I'm going to do is, in order to save you time, because time is money, and I appreciate the fact that you're even watching this video. So what I'm going to do is I'm just going to scroll through the transcript. And what I did in preparation for this particular video is I just highlighted a few of the, let's call it the highlights reel of the transcript call. So you don't have to read the whole thing or listen to the whole thing unless you really, really don't have a life like me. So let's see what happens here. Vicky says we generated $1.6 billion of free cash flow, which is our highest level of quarterly free cash flow in a decade. Well done, Occidental. We also closed approximately $500 million of divestitures. We repaid $174 million in debt and exited the quarter with $2.3 billion unrestricted cash. This is all good, right? In addition to that, just by the way, in case you don't know, Occidental also has a facility of about $5 billion, which is available and at this moment in time completely unencumbered and undrawn. First quarter production from continuing operations over 1.1 million barrel of oil equivalent per day, with total company-wide capital spending of only $579 million. That's exceptionally good. You know, like if you do the math on that one, that's good. These are good numbers. Our domestic oil and gas operating cost of $7.20 per barrel of oil equivalent includes about $83 million of atypical costs related to the winter storm. So there's your cost in case you're wondering what a Uri cost. Occidental, about $83 million. Full year domestic operating guidance has only increased by 10 cents per barrel. That takes the cost of the winter storm into consideration. OxyChem, man, what a superstar this is in the Occidental portfolio. OxyChem benefited from robust PVC pricing. You thought lumber was expensive? You got to see PVC, huh? It's all these people putting up privacy screens and all the plastics that are required in piping and masks and all kinds of stuff, you know. So anyway, PVC pricing and gradual strengthening in the caustic soda market. We do know from a previous report that OxyChem is one of just two manufacturers currently who have the ability to supply chlorination products for swimming pools and for purifying water and so on. Midstream and marketing's outperformance are compared to guidance in the first quarter and primarily driven by our ability to optimize long-haul gas transportation in the Rockies, along with the timing impact of export sales. More about that in just a second. After a pause on the issuance of new drilling permits. So this is an interesting one for me, guys. So, you know, of course, you know, Biden came into office and said no one's going to drill on federal land anymore. So here's Vicky saying, after a pause on the issuance of new drilling permits. So basically there is a pause in terms of new permits on federal land, but we have now started to see the process move forward again with the approval of new permits. Well, I'm not a politician, so I can't really explain this stuff to you, but the fact of the matter is there will be no more new drilling on federal land. We have now started to see the process move forward again with the approval of new permits. I don't have an opinion on this one, guys. I'm just reporting, you decide. We currently do not expect the permitting process to have an impact on our activity levels, as we still plan to run an average of 11 rigs in the Permian this year and 2 in the Rockies. An update to our divestiture plan is to sell $2 billion to $3 billion of assets by the middle of this year. Our progress towards this target continues, as we've closed almost $500 million in the first quarter. So that's kind of like a bit of a challenge, this target, 2 to 3 billion in assets by the middle of this year. This makes me think that they probably have a deal in the back pocket, but they can't talk about it yet, because to jump from $500 million or $500 million to 2 to 3 billion in this quarter that we are currently in is quite a jump. Let's go down a little bit more. Here we're getting to the meat of the bone. This is Rob. So the sort of motherhood statement in terms of Oxy and where they're going and what it is now finished, and now we are looking at Rob. We focused on deleveraging and continued to reduce our debt. For the first quarter of this year, we repaid approximately $9.6 billion of principal since August of 2019, so almost $10 billion. But watch what happens next, right? Rob says, while credit ratings are based on several factors, including a certain level of debt, returning to investment grade, which is IG, in case you see it later in the report and you wonder what IG is, so investment grade debt, in a mid-cycle commodity price environment may include reducing debt to the mid-$20 billion range. So here you have a target, because currently Oxy's long-term debt is at around 35-ish. So going down to the mid-$20 billion range requires Occidental to settle another $10 billion worth of debt. We repaid $174 million of debt in the first quarter, and now we have less than $225 million of maturities due for the remainder of 2021. That's a good position to be in. We may also consider retiring $750 million, it's almost $1 billion, of notional interest rate swaps later this year for the fair value amount, which was approximately $665 million at the quarter end. This would improve our cash flows by almost $50 million per annum at the current curve. For the first quarter, we announced an adjusted loss of 15 cents per share and reported a loss of $36 per share. A number of people questioned the difference between the two. So here's Rob saying the difference between our adjusted and reported results is primarily due to a gain on asset sales and positive fair value adjustments offset by planned lease expiries and a legal contingency related to our 2016 settlement with Ecuador. We were able to add additional gas hedges in the quarter, and we've now hedged approximately half of our 2021 domestic natural gas production with a floor of $2 per million cubic feet. We are on track to spend within our full year capital budget of 2.9. We are on track to spend within our full year capital budget of 2.9 billion, having incurred capital expenditures of only $579 million for the first quarter. The CapEx is going to be significantly higher in the second quarter. We'll get back to that one in just a second as well. Generated $1.6 billion in free cash flow and exited the quarter with $2.3 billion restricted cash on hand. Nice. Over half of the working capital change was due to the commodity price, and we kind of know that, right? And here's the reference that I'm always making to GAAP when I talk about the accounting, right? Some of it reflects the timing difference between when the revenues are recognized and when the cash is received. If you watched my previous couple of videos or so, you would have remembered I made an example talking about Boeing, where if you have an order for 100 planes and the planes are only going to be delivered, let's say in total, the entire order of 100 planes are only going to be delivered by 2035. When do you recognize the revenue and when do you receive the cash? These make a difference, and as long as you're consistent in terms of your GAAP financial reporting, the IRS says that's kind of okay. Revised guidance combined with our operational achievements have enabled us to lower our 2021 break-even to a mid-30 range on a WTI basis before the preferred dividend. So many people ask about break-even. So here you can see that the guidance for break-even for 2021 is in the mid-30 range. In the previous quarter, Vicky had said it is in the high 30s. There's quite a difference between $38, $39 and $34, $35 or whatever the mid $30 range actually ends up being. Our full year production guidance of 1.14 million barrels of oil equivalent per day remains intact, as does our full year capital budget of 2.9 billion. Good job, guys. So I'm just going to skip over this, and what I want to do is I want to spend a bit of quality time just talking very briefly about my very favorite analysts, because you guys know I really love these guys. So this first one is Dan Boyd with Mizuho. He talked about the free cash flow outlook. He had a question about that. Rob Peterson responded, said, our revised guidance, when you combine in operational achievements, did lower our break even, which was $30 in the mid $30 range on WTI before the preferred dividend, as I just said a minute ago, so forgive the duplication. Dan also asked a question about direct air capture, and Vicky said we don't have any concerns about being able to finance our first direct air capture facility. The next questions came from Neil Dingman with Truist. He talked about permits. Vicky gave a longer reply here. I'm going to just touch on this briefly because I talked about the permits earlier on, which is a little bit confusing. But anyway, my concern is that there could be a moratorium, a longer-term moratorium on picking up additional leases. That would be bad for our industry. It would be bad for the United States. It would put our country in a position where we would likely have an even tougher time increasing production above where the United States is today. Here's a little bit of history. As you know, we were at one point over 13 million barrels per day of oil production in the United States. That's a scenario that gave us strength in world politics. It gave us the ability to completely deploy our own oil and products domestically. We would not have to import very much at all at 13 million barrels per day. I believe our refining capacity is somewhere near 17 million. So we would have some capacity to be almost completely independent. With a moratorium on federal leases, that would really drive down our industry's ability to react. Nowhere now where we are in that, we have 9.5 million acres to develop in the United States. This is Occidental. Of the 9.5 million acres, only about 1.6 million are on federal lands, and about half of that is offshore. So from a new lease standpoint, there are some companies that are in better positions than others. And Vicky says, I believe we, as in Oxy, are. Some good news, but anyway, I don't want to get into the politics because it just makes me burst out in tears. So Neil also talked a little bit about carbon capture. I'm going to kind of skip over that just to the sentence over here. With CO2 enhanced oil recovery, we've tested it. We've run 4 pilots. This is Vicky. And we now know that we can potentially get 75% additional recovery, or maybe even double it. Maybe even double it, obviously 100%. The next question came from Doug from Bank of America. Talked a little bit about the break even. He reverse engineered the calculation and said 1.6 billion of free cash, obviously before working capital, annualizes 6.4 billion, $215 million per dollar is $30, and the average WTI for Q1 was 57.61. How do you get to the mid-30s? Well, firstly, I can just respond to this one even before Rob Peterson does. You can't just take the average price for the quarter and say it was 57.61. I just mentioned a minute ago, it depends on when the revenue is recognized and when the cash is actually received, which creates a bit of a delta in terms of the average price. So when you have an average price of like, $50 in January and $60 the next month or whatever, you can't just average it out and say this is how it works. That's not how a break-even calculation works. Rob said what's missing from your calculation is certainly that the capex, and then also I would say the chemicals. The midstream inclusion in Q1 is more of a one-time event associated with Winter Storm Uri. Doug said, okay, the delta is about $7, but we can take it offline. I'm not sure where that's going to go, but it'll be interesting if Doug actually provides some feedback once he's had a discussion with Rob, perhaps one-on-one. The disposal update, a little bit more progress this time, has still got a long way to go to get to the 2 or 3 billion. That's what I mentioned just a minute ago. It's kind of a steep target. For the second quarter, Vicky said, we currently have offers in hand. Remember I said there might be something in the back pocket that would get us well above the $2 billion minimum target. However, in this environment, we expect that we would meet the $2 billion. They got a deal in the back pocket. They know something we don't know. They just can't tell us right now because that would be fiscally and from a governance point of view, completely irresponsible and inappropriate. Neil from Goldman Sachs talked about the cash flow. Why was the working capital number so large? This is Rob Peterson. He says the majority of that was driven by the change in the commodity prices. It was a timing difference between revenue recognition and cash received. There we have it again. The same thing I keep harping on. It's like you cannot, accounting is not a science. There's no peer-reviewed study and then you arrive at a conclusion. It's gray. You never quite know exactly what it is. So at the end of 2020, WTI was about $48 a barrel, and then it was $61 a barrel at the end of March. That's a huge gap, right? So you can't just average it out and say, okay, I'm just working with that number. And so with this price increase, 30% impacts both our accounts receivable balances and our inventory significantly, especially when you consider our midstream businesses and how many barrels are on the water at any given time. Why is that important? We've had to change our mix or portfolio of export shipments, which are, for now, for the most part, heavily weighted to. It's not exclusively related to shipments to Asia, which is longer voyages, more crude on the water for longer because of the transit times. Interesting stuff, right? Most of Oxy's production is going to Asia. Neil also talked a little bit about the chemicals business. Margins are very strong. Rob responded and said, going into the end of 2020, we've already had a pretty tight supply-demand balance in the second half of the year. And that was coupled with a pretty significant amount of damage through, though building products are in very high demand right now. So we see PVC demand and margins of significant already going into the year. And so in the case of PVC, construction investment is very strong. Demand is expected to remain strong with the housing starts outlook, low mortgage rate, a lot of emphasis on remodeling, etc. And right now that is driving that PVC demand. And so with resin tight in the domestic market, we are able to expand margins just like we would in our commodity supply demand balance. We're seeing caustic soda bottom. Oxy has a significant amount of other derivatives beyond just PVC that we sell that gives the company a lot more variability in the molecules that it can sell, produce additional caustic soda and produce additional value in other parts of the chlorine chain, which is going to expand our ability to increase the value delivered by the business. And really, it is a remarkable business. We're talking here about OxyChem. Janine from Barclays talked about how do you get down to the mid $20 billion range on gross debt? That's $10 billion from where we are right now. Rob said, well, is it exactly 20? 10 billion, right? Obviously, a lot of different things that go into that factor into that, as indicated in my remarks, but it's going to be somewhere in the neighborhood of that. So we know what the target is on debt reduction. Janine added, there's a sustainable dividend, there's growth capital, and now we have a bogey roughly on gross debt. Rob said we are squarely focused on leverage reduction right now and looking at the opportunity to get down to investment grade type level, IG. Embodied in that is going to be using the proceeds both from a free cash flow point of view in the business, using the proceeds of the divestitures that take place and combine those two things together to reduce the cost, what we have outstanding. Vicky added, so there will be continuing shareholder value growth through margin expansion. Well, the lower the break-even cost goes and the higher the WTI price goes, for example, the better the shareholder value growth through margin expansion. Devin from Morgan Stanley talked a little bit about cost reduction opportunities. Vicky responded and said, and the exciting thing in looking at our data today is we've decreased our drilling cost from $200 a foot in 2015 to $135 a foot in 2021 for our global drilling. That's everything around the world. Isn't that amazing, guys? It's like here we are sort of 6 years later, and they've reduced their drilling cost down from $200 a foot to $135 a foot. Vicky adds, we're setting records on how many fracks we can do in a 24-hour period. Some of the data, by the way, is just like amazing. In New Mexico, in several of the areas that they worked really hard, they lowered our break-even on some of those areas by $10 a barrel. That's pretty good, man. This is Devin. Second question, I'm skipping over this one because it's more just more questions about Occidental Low Carbon Ventures, and it's kind of a little bit repetitive. Leo from KeyBank asked about the first quarter CapEx that did come in quite a bit below expectations. Vicky said part of it was driven by the ramp up, and we will have our highest spend capital quarter next quarter, which is the quarter we are in now. So if you average the two, it's going to be first half spending will be about the same as second half spending for the year, maybe slightly less. Rob added Q2 will be our highest. So here we are looking at CapEx, and Rob is saying Q1 was very low and Q2 is going to be the highest, but it's going to average out. So don't get a fright next quarter, and don't get some extraordinary scare when you see the CapEx for Q2 is significantly higher than what it was for Q1, because you have been warned. Rob added, and you can see that with the Permian, where we only spent a couple of $100 million in the first quarter of this $1.2 billion. We only spent a couple of $100 million in the first quarter of the $1.2 billion budget for the Permian. Leo also added some questions about the midstream. Rob said, if you look at the first quarter, we beat our guide by $234 million. Then we raised the full year outlook $200 million. So basically, last quarter to this quarter, we're expecting a deterioration of about $34 million on the remaining 3 quarters. So beat the guide by 234 and raised the full outlook by 200. Rafael Debois with Société Générale talked about the quantity of caustic soda that will be required for the very first plant. He's talking here about OxyChem. Rob said the working fluid and the direct air capture unit is caustic potash, not caustic soda. I have no idea what the difference is between the two. I'd have to look it up. So it's AOH and not NaOH, but we haven't disclosed utilization of what that first full volume might be like, or like the first direct air capture unit moving forward. Vicky also added, we're still in the engineering phase of that, and we are still optimizing it. So guys, that is sort of a wrap of the earnings call. There's nothing groundbreaking there. Obviously, the slide deck is available on the web if you want to kind of comb through that one. It's got all the pretty pictures in, and of course, it's done by the marketing department of Occidental Petroleum, so you'd expect it to look pretty and pretty much give you the highlights reel in a very palatable, positive, optimistic type format. As a general rule, when I started off, I said it's like a motherhood statement from Vicky on the conference call. But then I like to go to the analyst questions and answers, because it's almost like looking at the balance sheet, where the real meat on the bone is in the notes below the numbers. When you listen to an earnings call, the real meat on the bone is in the analyst questions after the motherhood statement about how the company is doing. Guys, that's a wrap. That's Oxy's earnings call. I'm going to be doing a bit of work over the next few days or so, just to sort of comb through the data, see if I can find anything interesting. And of course, if I do, I'll be sharing it with you. So on that note, this is Mr. Oxy saying thanks for watching. Take care. Stay away from COVID. I'll talk to you soon. Bye-bye.